Let's welcome in Tom Lee now. FundStrat's head of research and a CNBC contributor with us, as you see, at Post 9. Welcome. It's good to see you.
Great to see you.
Let's hit tech first. Should we be surprised at this resurgence, this melt-up? And it's maybe caught some people by surprise.
I think investors should realize 2024 has been a year of surprising strength. The market has avoided so many opportunities for weakness. And now we're entering the final weeks of the year where we know there's still $7 trillion of cash on the sidelines and quite good visibility in next year. So I think stocks should finish very strong.
Why do you think money is going to the mega caps now in the manner that it is? Up 1.75% today, the NASDAQ up almost 4% over a month, and able to achieve this milestone.
One reason is mega caps have been leading. So it's sort of what people reach into the shelf when they're risk on. But second, we know that when interest rates fall, the mega caps actually are very sensitive to that. And I think today was a day where the odds of a December cut increased. You know, the probabilities are now solidified. And that's actually bullish for tech.
Because the CPI was, you know, some would say sticky, but it was largely in line. Is that how you read it?
Yeah, that's right. And I think it's allowing the CPI print today allows people to imagine a path to 2% because shelter now is cooling to a level that's in line. Auto insurance, which was at 25% earlier this year, year over year, is now down to 13%. So the two biggest contributors to CPI are in a downshift. I don't think the fact that used cars are going up is going to reverse the Fed's view. I don't think the Fed's going to tighten because used car prices are up.
All right, so Fed's cutting next week. That's your base case?
Yes.
And then what happens after that? All bets are off? Wait and see? What do you think?
I think the Fed put remains in play because neutral is, let's say, 2.5% to 3%. We're at 4.5% after the December cut. So we know the Fed's in a cutting cycle. I actually think the best case is for the Fed to do the fewest number of cuts next year.
That means the economy is pretty strong.
That's right. It's strong. They're not harming the economy by keeping rates here. And the labor market is holding up, and now we have a lot of firepower for future cuts, which support stocks.
Okay, you talk about a Fed put. You also talk about another put, and that's a Trump put.
Yes.
He's going to be here tomorrow, by the way, ringing the opening bell. People are excited about that down here for sure. But you say that that is a substantial part of your outlook for the new year. The Trump put, explain.
The Trump put is, on the simplest level, it is a White House that is going to measure its success by how the stock market performs. But it's also a president that's coming into a second term, but with a lot of previous experience. So this is a cabinet that has good private sector acceptance, and I think very markets friendly. Overall, I think investors who might have been cautious for the last few years now want to be risk on next year.
All right. So your outlook to me is interesting, the way you sort of game out where the S&P can go, because you say we're going to 7,000 by mid-year, which sounds amazing because most targets that I've seen are 7,000 at the top end for the entire year. Your full year forecast, though, is 6,600. Why?
Part of it's cyclical. We're coming off two back-to-back 20% years, and there are 5 precedents to look at. 5 of the 5 precedents since 1880 had a weaker second half. So I'd say that's the base case. The reason I think markets do better in the first half is that there is going to be a lot of enthusiasm about a new White House, some of the headlines that come, whether it's deregulation, et cetera. And we know there's still a ton of cash and a lot of low leverage on the sidelines. That's why stocks can rally. And by the way, 11% in a few months, we've seen that routinely the last couple of years. But in the second half, I think markets start to worry about the larger macro risks like the Middle East, the potential risks of tariff and executing that, and potentially the fact that Doge could be so successful that it could slow the economy.
You're worried about being too efficient, cutting too much, and what the impact is going to be?
Yes.
Is the Nvidia boom period about to go bust with stock taking hit after hit recently? Or is there a second act in this high-stakes play for AI dominance? With Microsoft, Alphabet, Amazon, and Meta platforms doubling down on AI investments, Nvidia's role in this digital renaissance is more crucial than ever. Yet, with Nvidia's stock taking a temporary breather over the past 6 months, investors are caught in a paradox of excitement and apprehension. What unfolds could be the saga of AI's gold rush era, or just another chapter in tech's eternal narrative of rise and fall. Welcome back to Investocracy.
The 10-year yield touching its highest level since April earlier today. But our next guest says the rise in yields could be a false flag. Let's bring in FundStrat Head of Research and FundStrat Capital CIO, Tom Lee. He's also a CNBC contributor. Tom, good to see you. Okay, so let's start there with the yield impact. What might people be reading wrong, you think?
Well, I wouldn't say markets are necessarily reading it wrong, but I would say as uncomfortable as we are seeing yields at near one-year highs, I don't think that this is going to be the level we see a few months from now. And I think that's more important because ultimately, if yields begin to fall because inflation pressures are easing or if the job market is a bit softer than expected, it really puts the Fed back in focus. So I guess what I would just say is it's not comfortable to be here at where yields are. I don't think it really breaks markets, but I don't think yields are necessarily moving higher over the next few months.
Well, it's particularly uncomfortable, arguably, for small caps. Early last year, probably around this time, you made a bold call on how much small caps could rise. You've moderated from that since. But where do you see small caps going now? Why didn't the big pop that you projected for 24 pan out?
Yeah, small caps have been disappointing. I mean, unfortunately, I think there's been a rug pull on those names a few times, so I think investors are going to be very wary. But to us, I think the roadmap for 2025 is still one where the opportunity for stocks to have much better breadth widens because not only do we have an incoming administration that is pro-business, and I think it is going to boost CEO confidence. It's pretty evident now, even seeing it in both ISM readings recently. But that's going to be a better environment for mergers. So to me, while small caps have been big laggards, actually for the last 10 years, this 10-year underperformance to the S&P is the worst in actually almost 100 years. So the second only to 1998. And then from a valuation perspective, small caps are still much more attractively valued. The median PE is around 11 times, and that's almost 7.7 turns cheaper than the S&P. So it's been tough, John, to be overweight small caps, but I think they're going to work in 2025.
Okay. I do want to get your thoughts on some of the riskier assets or the riskier parts of the market that, or I'll use the word maybe potentially more speculative. Case in point, the quantum computing stocks, they had a huge move higher. Jensen Huang from Nvidia comes out yesterday, makes comments saying that, some of the supercomputers are still, and the full realization of supercomputers is still decades away, and you see all the stocks tumble. I know there's one that you like in your granny shots here. I believe it's IonQ. Just want to get your thoughts on what we've seen in some of these parts of the market and how to think about investing, if you should be investing in some of these more speculative or futuristic frontier tech-like companies.
I think investors do need to put a long-term lens on a lot of these important mega themes. I think quantum computing is in the earliest days. I don't think anyone can judge really whether it's 15 years away or 15 months. And I think people have made many mistakes over the past 20 years looking at things like social media and underestimating the adoption rates there, or internet, or even AI now. I mean, just think about 2 years ago, how many people were saying AI was going to actually take far longer than expected. That being said, I do think the environment for stocks hasn't been great for the last 3 weeks. I think it's really gotten people into a recency bias thinking, look, we've neared a top or that stocks are just awful now. I think we're getting close to the point where, you should be betting really and leaning heavily against that. I mean, even look at AI sentiment, it's almost back to negative. But Morgan, regarding quantum specifically, it is a pretty innovative technology. I think these are going to be high volatile names. And so until we get back to risk on, they are going to be tougher names to own. But I don't think that means you have to sit them out in 2025.
Nvidia's GPU market share, towering at an awe-inspiring 98%, tells a tale of unrivaled supremacy. Yet, the suspense thickens. Investors, peering into crystal balls, speculate Nvidia's meteoric rise might culminate in a plateau. But in the world of finance, forecasters have been known to miss the mark as much as a novice stock picker on a frantic Monday. The astounding truth is major tech titans remain unwavering in their reliance on Nvidia, with capital budgets soaring like a UFO sighting over Silicon Valley. To back it up with data, Microsoft's AI aspirations have woven Nvidia deeply into its fabric, earmarking it as the core supplier of data crunching that is essential for the AI frontier. Not to be outdone, Meta Platforms unveiled its Llama AI models, pouring billions into creating tomorrow's AI landscape where Nvidia sits royally atop. But before going on with the video, are you into cryptocurrency? If so, check out our second channel, Investocracy Crypto. We bring you breaking news, expert analysis, and the latest trends in the fast-moving world of digital assets. Whether you're a seasoned crypto investor or just curious about the future of finance, we've got something for you. Click the link in the description to subscribe to Investocracy Crypto now. Don't miss out and stay ahead of the game. Now, let's get back to the video.
All right, joining me now, Mark Newton, Global Head of Technical Strategy at Fundstrat Global Advisors. Mark, good morning. Thanks so much for joining us.
Thanks, Frank. Great.
All right. So we just heard Rick Reeder say the market's got some pretty good footing. He sees, more upside to come. We actually want to look at some areas of the market where there's been a little bit of pressure, and you also see some upside. Why don't we start with the S&P 500?
Sounds good, Frank. Let's take a look at the S&P.
Yeah. So, Mark, if you don't mind, if I start, for the last month, S&P down. We're going to go over here. A little bit of weakness, down about 3.5%. But you're saying there's an upside trend overall that you're bullish on.
Yeah, I agree, Frank. When you look at the longer-term trend, despite all the damage we've seen in the market this year, starting really last December, we have not really seen sufficient evidence of the market truly breaking down. That's thanks to technology. So 5,700 is really an important spot. Any sort of weakness into CPI, that would be something investors really want to consider, that trends have not shown sufficient deterioration to turn to negative at this point.
So does that signal we're going to see a bounce in the S&P 500 after CPI in your mind? Is the momentum just going to pull us that way, even if we get a hotter than expected CPI, or is it dependent on the CPI report?
So, look, Reeder has his fundamental thoughts. I have my technical thoughts. Both of them say that markets are near levels within 3 to 5 days where we're going to bottom out. So longer-term trends remain intact. Sentiment's gotten a little skittish. Technology, to its credit, has been able to hold the market up. That's a great point and really a reason why we're likely to stabilize. Significant support down near 5,700. Not only is a line up with last November's lows, but also lengthier long-term uptrends just from 2023. So really, really good support is a good time to buy, in my view.
Sentiment might be a little bit more than skittish. I think the VIX is up to about 20 right now. So a lot of index investors especially are going to be glad to hear you say that there's going to be a bounce in the S&P 500. We want to move to one of the most widely held stocks in the market. That's Nvidia. So I was just looking at the charts myself. I'm not a chart master like you are, but I was looking at the charts myself. Since CES, which is a very small part of this chart, I'm looking at Nvidia, down just about 8% since there. We all thought that alligator jacket would lead to a rally. I guess it didn't. But you're saying there's a trend here that you're seeing as well that's setting up Nvidia for a potential bounce.
Yeah, so despite a lot of the carnage we've seen in semis since last July, I mean, look at Nvidia. This continues to be a standout leader. And similar to the broader S&P, the stock has pulled back to almost exactly where it needs to think that, okay, it's a great risk reward. Short-term weakness, but no longer-term trend damage. Investors want to be buyers into this pullback.
And the evidence keeps piling up in favor of Nvidia. Nvidia's latest conjuring, the Blackwell chip, already sold out for the next year, promises to propel this narrative forward like a data center on caffeine. With its allure, possible envy of other chip makers, Nvidia is setting the stage for Future 2.0, a future steeped in AI, where data is as treasured as a gold rush pan in 1849. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
All right, so I just want to ask you this. Nvidia is a chip stock. These are cyclical stocks. So when you're looking at the technicals of this stock and you see this trend, any concern that the cycle comes to an end at some point, and that's the downturn?
Well, we have to let the stock tell us that. Okay. And unfortunately, we can't bet against ongoing uptrends. Most of the stocks is down about 15, 16% from its July peaks of last year. Nvidia still within striking distance of all-time highs. So, it seems like a very severe short-term pullback. The key lesson for investors is always put the short-term price movement into context of what the longer-term charts are showing. And so the longer-term charts show this remains in great shape.
We got one more. We got to do this one quick, Mark. This is the equal-weighted financials. So, again, I'm looking at the charts. I want to be like you. I want to be a chart master. Last month, equal-weight financials actually down just about 5%. What's the trend that you're seeing here, and how does it impact it or influenced by earnings season?
So look, financials is one of the largest sectors within the S&P outside of healthcare. You know, technology being number one at 30%. Similar to all these other charts we've seen, the pullback has not done any real damage. We're down to levels that make really, really good sense. And this is an equal-weighted financials from Invesco. So we strip out the Berkshire Hathaway, the JP Morgan. Financials has pulled back to a great level. My thinking is yields start to roll over. That's been specifically coinciding with this market carnage. I like buying financials.
So, is it too late to join the Nvidia bandwagon? The answer is simply that there is not a more perfect time right now to buy Nvidia and hold right before it explodes further with Blackwell. Past the initial frenzy, Nvidia sits poised to navigate the broader AI awakening. Consider that even now, Nvidia trades at a valuation that hints at substantial promise. Its price-to-sales ratio is inviting. But what do you think? Is Nvidia's allure compelling enough to be the portfolio's crown jewel? Or just another chapter in the age-old saga of technological evolution? Share your thoughts. And finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.